Hi there. Welcome back to yet another episode of E.M.I for the month of September. In this month's E.M.I, we talk about five important topics: past Fed rate cut cycles, Fed rate cut cycles and the US business cycles, markets 1 year after the first Fed rate cut, RBI rate cut cycles and the Fed cycles. Is there any relationship? And finally, on the dollar index. Apart from that, we also talk about how one should look at markets at all-time highs, investors in particularly, and we look at risk return portfolios and try and understand why diversification is so important in today's market. We start off with the most important slide: Federal Reserve rate cuts. There are two very important Federal Reserve rate cut cycles that we have seen in the past: the global financial crisis rate cut and the dot-com bust. Now, apart from these two rate cuts, if you examine all the other rate cuts in the past, you can see that the Fed had myriad reasons for cutting rates. Most of them were external in nature. For example, you look at the rate cut here, it was external in nature, it was COVID related. This was just after the Fed started its mid-cycle adjustment rate cut around mid-2019. You had the Great Recession that started off in 2007, and somewhere down the line, they figured that it wasn't working well. They had another set of rate cuts with QE that started after the housing market crash. You had the dot-com bubble that started, rate cuts for the dot-com bubble that started in 2000. But somewhere down the line, you had 9/11 and you had additional rate cuts for that. You had a mid-cycle adjustment here, and you had a long Gulf War recession-related rate cut that took place in late 1980s. The second part that we have to understand is Federal Reserve cut rates. Has not really been the most important policy tool of the Federal Reserve all through. The Federal Reserve's Fed rate becomes an important policy tool only after the 1990s, somewhere around the 1987s or so. But for all practical purposes, it looks like the Federal Reserve's policy rate becomes relevant post the 1990s. So any analysis of market reaction of Fed rate cuts or hikes before this period of 1990s, exactly to be specific, around 1987, would not really be very pertinent. Before the 1987, what was the policy tool then? It was largely money supply focused. Money supply was the most important policy target at that point in time. And do remember that the nature of the economy was very different. The Federal Reserve was not really giving forward guidances at that point in time, unlike now, where there are very clear policy guidances that are given. There are policy meetings that are done on a much more frequent basis. Now then we come to the next and the most important slide, looking at rate cuts in context of where the US economy is at that point in time. So we look at business cycles and we look at rate cuts during US business cycles. Now, all the green dots that you see in this chart are places where the Federal Reserve has cut rates. And the blue line that you see in this chart is the OECD CLI. The OECD runs something called the Composite Leading Indicator Index. You can find details here on the right side of the slide. There are three things you must remember when you read an OECD CLI index. Any number that is above the 100 threshold tells you that GDP for that country is above its trend. So for the US, the number seems to be almost exactly at 100, indicating that GDP is at trend at this point in time. Second is, if you see the line of the OECD CLI trending upwards, which means the month on month is positive, an upward trending slope of the OECD CLI indicates that economic activity is getting better and better. By the converse, it means that if the economic activity is getting worse and worse, the slope will actually start moving lower. Now, the third and the most important part is the OECD CLI is an indicator that tells you where the economy would probably be 6 to 9 months down the line. So it is very useful in identifying turning points in the economic cycle. If you analyze the OECD CLI and then look at rate cuts, a very similar point in time that you can find is the 1998. It was an external reason where the Federal Reserve cut rates because there was a currency crisis that was happening. If I recall right, it was ruble related, Russian ruble related. The second phase where it was close to 100 was the late 1980s, where the Federal Reserve started rate cuts. Now, this situation where the US is in probably can be linked to a 1998. So what we're trying to say is that the rate cuts that the Federal Reserve is expected to deliver next week could possibly push up economic activity like it did in its short 1998 rate cut cycle. And therefore, what we are trying to say is the rate cuts that the Federal Reserve is likely to deliver next week can be called insurance cuts or mid-cycle adjustments, as they were called around the 1995 cycle. We then come to the third segment. How did markets behave when the Federal Reserve cut rates? There is a lot of data in here. You can take your time and look at market reactions across asset classes. It's fairly detailed. But there are three most important things that you must take away when you want to understand how markets behave to previous Federal Reserve rate cut cycles. Firstly, like we talked about earlier, all the most important Federal Reserve rate cuts in the recent past have been delivered just before recessions in the US. This time around, it does not look like the US is getting into a recession like we saw on the previous slide. Economic activity is at trend, and the economic activity trend appears to be increasing, indicated by the upward sloping OECD CLI. The second part is every single time in the last two key recessions that happened in the US, which was the reason why the Federal Reserve cut rates, three sectors have outperformed: staples, discretionary, and pharma, both in US and in India. And the third takeaway is, again, the last two times, US large caps appeared to show a growth bias that you can see here. You can see that S&P 500 growth stocks appeared to outperform the S&P during all these phases. So there is not really much to take away from market reaction. There are some nuances here and there, but the most important point is this data of market reaction to Federal Reserve rate cuts and sectoral analysis would be relevant only if you expect the US to go into a recession and the Federal Reserve's rate cuts next week to be read from that point of view. We don't see the US to get into a recession, and we also see the Federal Reserve's rate cuts to possibly be marginally positive on growth, and it is broadly seen as the Federal Reserve's attempt to bring growth back on, rather bring the labor market back to speed. We then come to the RBI's rate cut cycle and the Federal Reserve's rate cut cycle. There is a very strong perception in the markets that the RBI always tags the Federal Reserve. Let's look at data and see what the data tells us. The RBI's repo rate starts from around 2001. Before 2001, we didn't really have the repo rate that the RBI targets. So if you look at these cycles, the most important period that you should notice is this period right here, where you had an entire rate hike cycle. This was largely because of the post-GFC stimulus that the Indian government had given. In hindsight, it was a slightly larger stimulus that caused inflation that touched nearly 12%, and the RBI had to raise rates. And then there was normalization. Then you had a taper tantrum. RBI responded to that. And after that, you had crude prices come down, and directionally, the economy was doing fairly well, and rates started coming lower. Through this entire cycle, if you can see where the Federal Reserve was, a large part of the cycle, the Federal Reserve did nothing to its interest rates. And the last part of the cycle, which is 2015 to 2018, the RBI was cutting rates even as the Federal Reserve was raising rates. This should sort of tell you that the RBI's monetary policy is not as driven by the Federal Reserve as one would perceive. RBI's monetary policy is largely dependent on domestic dynamics. Let's look at a short reason here as to why the RBI was able to deliver rate cuts when the Federal Reserve was raising rates. So if you look at this 2013 to 2018 phase, average net FII inflows were fairly positive, 1.6 billion on average monthly. CPI had dropped around 500 basis points to 5%. GDP moved up by nearly 350 basis points to 9%. Crude dropped 33% to around $56 a barrel. trade deficit dropped 5% of GDP to 5%. Remember, crude really came off sharply during this period. And as a result, the current account deficit dropped 2.5% of GDP to 2.5%. So, short point here is RBI is not wedded to the Federal Reserve's rate cycle. The Federal Reserve's rate cycle is important, but the RBI's monetary policy is largely determined by domestic macro dynamics. This chart here talks about where the Indian economy is right now. So you can see a drop in coal offtake here, slightly lower than seasonality. Now, if you go into the reasons why, we've had a fairly good monsoon, and you've seen stronger than expected rains that have led to a drop in coal offtake. You've seen petroleum product sales drop. Largely, it appears to be diesel related. So this is something that markets will have to very closely keep an eye out for. This might have an implication to the CV cycle. If you see a pickup there, it might indicate some improvement in the CV cycle. If you look at activity on the whole, manufacturing PMI numbers have been moderating, but remember, this is well above 50. Any number on the PMI above 50 is an expansion, below 50 is a contraction. So this drop in moderation in the manufacturing PMI numbers is broadly in line with the global trend. Services PMI is holding fairly well. Now, on the currency, you've seen a fair bit of a depreciation in the dollar index in the month of August and in the month of July. This you can see translated in an appreciation in most emerging market currencies, except the rupee. Now, it could be that the RBI, the central bank, is not wanting the rupee to appreciate significantly, probably defending a level. We don't really know. But we have seen a fair bit of an increase in forex reserves also that the RBI has been amassing. So whenever the RBI buys a lot of forex reserves, it puts pressure on the currency and does not allow it to appreciate. That could be a reason, but we will probably know in another couple of months when data comes out on RBI's forex purchases. We now come to this chart here that talks about the dollar index. As you can see in this chart, the dollar index has seen a fair bit of a drop in the last couple of months or more, largely on rate cut expectations from the Federal Reserve. You can see this mirrored in the Asian dollar index, the ADXY. So note here that the ADXY is inverted in this chart, which means a drop in this light blue line means that the ADXY index is increasing. This ADXY index improving indicates that Asian currencies are strengthening, taking cue from weakness in the dollar. Now the question then is, why is the dollar falling? Here are two charts that tell you structurally why the dollar goes up and why the dollar comes down. The dollar index goes up and comes down. Every country has deficits and surpluses. And if you look at two areas of deficits and surpluses, you have the government balance or the fiscal deficit or fiscal surplus, and the second is the current account deficit or current account surplus. Like India, India is a twin deficit country. We have current account deficits and fiscal deficits. The US and UK, which are developed economies, are also twin deficit countries, but people don't call them that way because they have a reserve currency as a backing. So the US is a twin deficit country. The relationship with the dollar and twin deficits is whenever you see the fiscal deficit in the US increasing, a rising fiscal deficit, you generally tend to see weakness in the dollar. And when you have a phase where both the fiscal deficit and the current account deficit in the United States as a percentage of GDP are worsening, you tend to really see weakness in the dollar. Therefore, improving fiscal deficits and current account deficits, improving twin deficits lead to strengthening of the dollar index, and worsening of the twin deficits lead to worsening of the dollar index. This is a very broad structural relationship between the dollar index and twin deficits. Now, if you come to more a medium-term index, what we really see is that real Federal Reserve's policy rate. So when you say a real policy rate, it means the Federal Reserve's policy rate minus inflation. Whenever you see real policy rates of the Federal Reserve's rising, you see the dollar index going up. Whenever you see weakening or drop in the real policy rate of the Federal Reserve, you see a drop in the dollar index. As of now, and the dollar index is closer to 101, and even if you do price in 100 to 150 basis points of rate cuts from here to end of 2025, and nearly a 40-50 basis points drop in inflation going forward by till December 2025, it sort of gives you an indication that the dollar index is unlikely to see any sharp drop from its current levels. We now talk about some updated slides on how the markets perform. So we can see here that Indonesia topped equity markets on 1-month returns, and US and India continue to sort of top markets from a 12-month return point of view. This relates to the currencies that we spoke about earlier. The most important takeaway here is that the dollar weakness that we saw over the last couple of months, over the last 3 months also, has translated into currency strength into most emerging market currencies. India has not really seen that translation though. Market capitalization to GDP is at an all-time high. And when you translate this into absolute numbers, total market cap in India is around 434 lakh crores, of which roughly around 65% is in large cap, and the rest of it lies in mid, small, and micro cap. From a valuations point of view, large, mid, and small cap are above their long-term averages. But the most important that you need to track is earnings growth across these cap curves. What must you know before investing? In this month, we talk about markets at all-time highs. How do you look at markets at all-time highs? How do you invest in markets at all-time highs? Now, this is a chart that shows the Nifty from 1990 September and tells you where all it touches all-time highs. All the dark blue bars here in this chart tell you where the markets have hit an all-time high. What we do then is we break this data down. We look at all-time highs and we see if you as a lump sum investor had invested in an all-time high market, 1 year later, 3 years later, and 5 years later, what do your forward returns look like? Now, we have summarized all this data that we crunched in 3 small tables. This pertains to large cap, this pertains to small cap, sorry, this pertains to large cap, this pertains to mid cap, and this pertains to small cap. Now, how do you read these numbers? Just look at the 12% row that we've highlighted here. What this data tells you is if you have invested at an all-time high market as a lump sum investor and you held on to your investment for at least a 5-year period, there is still only a 34% probability that you have made more than 12% CAGR. There is only a 39% probability in mid cap that you have made 12% CAGR, and there is only a 35% probability in small cap that you have made more than 12% CAGR. Now, what should you do? If you are a lump sum investor investing in the markets today, you have 2 choices. You should either move into diversify your portfolio if your time frame is fairly short, is 5 years or less. If your time frame is 5 years or more, then you don't really have much to worry. You can have a larger equity portion. But if your time frame is 5 years or less, you must look to diversify your portfolio and try to improve your risk return metric. We now come to what is your risk return metric like. Now, there's a lot of data in this slide, and there's a lot of charts here as well. How do you read this? So this is your ideal risk return curve. Now, how have we made this study here, this analysis here? So you can look at this here. We've taken 3 indices, the Sensex Total Return Index, the CRISIL 10-year Gilt Index, and gold in INR terms. And then we've converted this, and we've taken 1-year daily rolling returns and rolling standard deviations, which is what we're using for volatility matrices. And then we calculate portfolios, really 50 combinations of portfolios for debt and equity and gold, and we arrive at this risk return curve. Now, how do you read this curve? On the x-axis of this chart, you can see returns, and on the y-axis of this chart, you see risk. How do we calculate risk? Risk is nothing but volatility. Risk is nothing but your standard deviation. So as a 100% equity investor, this is what your risk return metric is like. It shows somewhere around 22-23% of return with risk, with volatility at around standard deviation at around 14-15% or so. This is where you are. Now, as an equity investor, your mindset always is to try to reduce your risk And in the process of reducing your risk, you have to trade off some return for it. As a bond investor, what you're trying to do is you're trying to improve your return, and at the same time, you don't want your risk to go up by much. So 100% bond investor would lie here, and 100% equity investor would lie here. For a 100% equity investor who's here on the risk return curve, and a 100% bond investor who's on this part of the curve, we have to understand that bond biased portfolios, they are adding equities to optimize on the return on the risk return curve, and equity biased portfolios, they add negatively correlated assets, which are debt and gold, to reduce their risk. So we have to arrive at somewhere in between. Let's take this example, this spot, for example. This is around 25% equity and 75% debt. This is giving you that magic number of 12% CAGR from a market standpoint, which is somewhere around 7% on risk. Can we find the same 12% CAGR return for a lesser level of risk? The answer is yes. What do you need to do for that? Add gold to your portfolio. And when you add gold to your portfolio, this is another sweet spot that you get. You get 12% CAGR, but for much less risk. So you got 12% CAGR here with around 7% risk. Now you're getting the same 12% CAGR by adding gold. That is giving you somewhere close to 5% risk. Now this is a theoretical case and completely unconstrained portfolio where you can have whatever ratios you want for equity, debt, and gold. So the sweet spot that we're talking about here is 10% equity, 45% debt, and 45% gold. In a real world where there are a lot of angles of tax arbitrage, a multi-asset portfolio has to also look at the tax angle there. So when you bring in the tax arbitrage component, for example, if you have a net 65% equity, you're considered as an equity fund, and your tax implications are very favorable, or rather very different. So when you look at in the practical world, you have to understand this is a theoretical contract construct that the data tells you. You have to add the tax arbitrage to it. And the key takeaway that you must have from this slide is diversification brings down your risk even for the same level of return. If you summarize all of this into two little charts, you can arrive at these charts here. The top one is on volatility. You can see an equity portfolio, the volatility, the maximum amount of volatility and the minimum amount of volatility over from 2001 to 2024. That's what data tells us. You are reducing the volatility range by adding debt, reducing it even further by adding gold. You're looking at the range on returns. You have a very wide range in equity. You're adding debt, your returns come down, your range of returns come down and come down further with gold. But what is happening here is you're stabilizing your returns and trading it off with much lower risk. So equity plus debt plus gold, you're getting an average return of 14% for a much lower risk of 8%. And lastly, and the most important in times like these, the four most dangerous words, according to Sir John Templeton, when it comes to investing are, this time it's different. This is Arjun signing off. See you next time on E.M.I.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.